All right, and welcome to the Jason Allen John Mortgage News Shows, where we're going to talk about all things related finance and how they affect you on a daily basis. So today we're going to talk about how the Bank of Canada rate is expect to uh, fight against inflation gains. We're also going to talk about um, how helping your kids with a down payment. There's a little twist to it, and you gotta actually do a lot of research and determine a couple of things. And we're also going to talk about being priced out in the market. And for first time buyers, how it's actually going to get a little bit worse. We might as well just get right into it. We're going to talk about the first time buyers first. So we're just going to get into this article. So, feeling priced out of the market, it's about to get worse. So, in regards to this article, we're just going to go down to it. The value of building permits homes is largely fast, and over the course of the pandemic, despite the month-to-month volatility, Statistics Canada data shows, and in recent months, gross gross domestic product in a broad measure of on how the entire economy is failing, it's clear that the investment in construction and housing has plunged in the third quarter. Now, these these market conditions are extreme, and the current stock for properties, the sales is not sufficient enough to have the number of transactions. And this is what we're seeing in the market. We're seeing the elevation of prices be related to the fact that there's not a lot of supply. And what we're seeing is that the building activity is not keeping up with the pace that we need. The market tensions are about to come face to face with two federal realities: raising interest rates and parliamentary policies. Over the medium term, rising interest rates can change the market dynamic. Cool off housing, says Gene says, but the immediate effect will make it harder for first time buyers to qualify, compounding their difficulties that they're having right now. It's hard to see if prices are going to come down at this stage, especially given the low inventory of homes. So, usually, what happens when interest rates go up, the prices kind of go down. But in this case, it's not happening in the same sense because we're in a situation right now where we just don't have any supply. It's just simple economics, demand and supply. So the Liberals signaled last month in the throne streets that their top housing policy would be a $4 billion housing accelerator fund to help cities cut the red tape, be more flexible with home buyers incentives, and a new rent to own program. So this is very important. They're doing what they can to kind of cut the tape. And to be honest with you, it's such a long process. And someone who dibble dabbles in a little bit of development, I can tell you it does take a long time. And it's hard to build housing in this country. It's expensive. And part of the expense is the time that it takes to get something to development. So if they can figure out ways to speed up the process, it can make a really good change in the environment. Sorry, zoomed out a little bit. Went to the wrong place. So anyway, so that's that article. So like when we look into that and we're talking as individuals, and I'm talking to you, my audience out there, like what do you got to do? There's no housing supply. Is there things that the government can do? Is there stuff that they could put into place? I think there's a multitude of things like, increasing the density for people to put secondary suites into their units. Also putting just more housing stock out there, allowing the builders to build more projects over time. Now, I know that's controversial because everybody thinks the builders, are just making a lot of money. But to be honest with you, with the way the cost in construction is, it's very hard as a builder to make a lot of capital. So that brings me to this next article, which talks about how are a lot of people being able to finance these buildings. Like, so right now, like, you know, a lot of money is coming from what? The piggy bank of mom and dad, or the piggy bank of brother and sister, whatever situation you're in. So we'll show this article. So now this article is that why helping your kids with a down payment is trickier than you think, right? So as housing prices have skyrocketed, more Canadians are turning to the family bank of their parents to help secure them on their first home. A recent report in CIBC found that a third of Canadians got financial help from their family in 2022. The average gift across the country was $82,000 compared to $52,000 5 years earlier. The average gift in Toronto was $130,000. Wow, that's a big bang. So often the disputes arise when a young couple were to break up. So says Caprices, if the married couple and they're trying to split their marital assets, the large form of money becomes a central argument. So even if the two weren't married, things can get complicated if they break up while owning a home together. Usually, gifts or inheritance are exempted from marital assets until that money is used to buy a home. Jointly held homes, meaning if the home is sold, could be split equally between homeowners. So as you can see, it can get quite difficult. It can get very difficult to manage in that process. So you got to be very careful when if you're a parent, you're going to be providing your kids and your could be your son-in-law or daughter-in-law with the down payment. It's got to be very clear. Now, if it's a loan, it should clearly say in the documents loaned out of the term that such a repayment schedule or interest owed in the event that might trigger repayment. So I like to talk about this a lot because sometimes in getting money from your family, from your parents, from your friends, you could view it as an investment for them. It's not only just like, oh, I'm helping Jason buy a house. What happens if you can use that as an investment and you could benefit as the houses goes up? Because a lot of times people will buy their home and all of a sudden they have equity in 3 or 5 years that they could actually pay back that investment that you have maybe helped them to get that home. It's a win-win. You make money, they get in their house, and it helps create a home buying process and keeps going. Especially a lot of the people that have unutilized capital or tapped in equity. So another thing is like, and that's where it makes it difficult. So that's why it has to be clear the contract that you set in place. Now we talked about in the last article how there's going to be a double whammy, a storm of things to come. Like so, we talked about how it's going to get a little bit tougher for first time buyers to purchase a home. So now we're going to talk about what is coming up with that next phase, which is inflation. Inflation is being the big topic of the word. And inflation, the way the federal government combats inflation is by actually raising rates, right? So what it is that when the Bank of Canada usually lowers rates, it's because they're trying to accelerate the economy. So there's a couple of policies when it comes to the Bank of Canada. Their mandate is to control the money supply and also to control employment. So if you see unemployment rising, one way they can spur investment is by lowering the target rate on the overnight lending rate. And what that does, it actually lowers the rate that you would pay or I would pay for my mortgage. So now what happens when it's an inflationary environment? That means the market's heating up and they have to find different ways of actually reducing the inflation. So ways they do it is raise the interest rates. So that means the cost of borrowing is going to be a little bit more expensive. So now let's go through this, right? It's going to go to the highlight right. For all intended purposes, Canada appears to be at full employment. Yet you wonder why, when looking at the pace of the broader economy, whether all the hiring is at least just premature. Because what we're looking at is gross domestic product was actually 1.4% below the pandemic level. And we weren't in full employment prior to the pandemic. So that's crazy. Like we had a surge of 186,000 jobs in the last 6 months. So the unemployment rate has tumbled to 6% from 8.2% over the last 6 months. So now when we take a look at that, the emergence of skilled worker shortage and the reopening phase might have also motivated employers to get ahead of the hiring curve rather than getting caught short staffed as business picks up in the expected coming months. So that could mean that they actually are overhired, which could be a down situation because that means people can get fired in the future, which could change some of the plans that Bank of Canada is making. At the time, the 12-month rate growth stood at 1.7%. But 2 months later, that rate has jumped to 2.7%. What's more essential is that the overall wage growth has come over the last 4 months, signaling wages have accelerated much faster than a year-over-year rate would suggest. So what we're going to see is further down the line, we're going to see significant wage inflation, which is the type of inflation that we're talking about. So now Bank of Canada may come and slow this all down by raising rates because they don't want the inflation to get out of control. Now there's arguing, different various points of view on how that works and what they should be doing at this point. But the thing about it is if we're looking at the bond market's actually signaling that they're probably not going to raise rates. So it's something we're going to pay attention to and obviously discuss over these next episodes and as the day goes on and the times go down, and maybe we'll get into some chart action that we could actually take a look at. So we're going to get into the last article of the day. And, as we were just the same thing is that, Bank of Canada's rate decision is going to depend on the variant. That's very important. And employment. So let's go through this again. So again, between 4.7% inflation, tight job markets, torn housing, and a cool currency, there's little standing in the way from a rate increase. A strong jobs report from Statistics Canada on Friday added to the argument that the economy is operating close to its potential and rates should be going up soon. Canada added 154 positions in November after a gain of 31,000 jobs in October. That's more than 4 times what Bay Street is projected. Now, other central banks have become hawkish, just like the Canadian bank. The U.S. Federal Reserve, Jerome Powell, said last week it is no longer appropriate to use the word transitory when describing the current bout of inflation. So at the beginning of the year, they kept on saying inflation was transitory, transitory, transitory. Now, transitory, what does that mean, Jason? Transitory means temporary. So the rate of inflation was meant to be temporary. But unfortunately, as you've seen, it's been very persistent. Now, is that inflation is going to be around forever? That's anyone's guess right now. And it's also unclear whether the wave of shutdowns would be inflationary or deflationary. Widespread health restrictions could hit oil prices and demand for in-person services, putting downward pressure on prices, but lockdowns could already hit stressed supply chains, putting upward pressure on prices. So actually, we're in a mix where we don't know where we're going. Like in some cases, we think it's deflation, but in some cases, it's inflation. Deflation's fighting inflation. Back and forth, back and forth, back and forth. And what's the government going to do? And that's key. And now when it comes to you who's going to make a housing decision, like what do you do? What is the case? Prices are rising. There's no supply. Interest rates are rising. So that means your monthly payment on your mortgage is going to go up. What do you do? Well, at the end of the day, at this point, I still think it's very clear to stay on variable just because I don't think rates are going to go up as high as everyone thinks it's going to be. And I do think that we're going to experience deflation. I think customers are going to reject the prices. And what I mean is that we're going to stop spending and we're going to hoard our assets and we're going to hoard our savings, which is going to slow down the economy. So this might be temporary. And like they said in the article, maybe the employers tried to get ahead of the wages and just really just wanting to get a head start. All right, guys, thank you for watching the show. Please to subscribe on the channel. And you know what it is. You know where you're going to find me. You're going to find me again tomorrow for the Mortgage News Show.